In summary, from an economic perspective, we're very pleased with how resilient the U.S. economy has been. After annualized GDP growth of 6.5% in the second quarter, the U.S. economy is now officially bigger today than it was pre-pandemic. However, the employment picture has not been as rosy. Given the fact that the low participation rate has led to some inflationary pressure on the wage front, we're hopeful that a relaxation of some of the excess unemployment benefits, as well as an abatement in the general fear of the coronavirus, will help to fill some of the 10.1 million open jobs in the US and ultimately keep a lid on wage inflation. From the perspective of financial markets, while the interest rate environment and the environment for traditional interest-bearing securities is rather bleak, we're pretty optimistic on equities today, especially looking at the equity risk premium, which measures the level of attractiveness in equities relative to fixed income, and the fact that multiples have compressed this year. Finally, we do see some opportunities on the horizon, as well as some potential risks. In terms of optimistic observations, the fact that there's a record amount of cash on the sidelines, we think provides the base for an optimistic equity market outlook. In addition to that, US businesses have proven themselves, beating on revenue and earnings, and ultimately exhibiting pricing power. In terms of potential risks, there is potential for margins to come down from highs we haven't seen since 2007. However, although it's not our base case, we just think it provides a need for selectivity. And lastly, there is a ton of political rhetoric coming down the pipeline that may weigh on investor sentiment in the fourth quarter. Thank you for watching, and we look forward to speaking again next quarter.